Every time money moves anywhere in the world, if they're dollars, U.S. Treasuries will be created, and the interest on those Treasuries is not transferable. So they buy gold. The price goes higher, higher. I believe they'll sell it to the Treasury as part of a deal, but the price will go higher, 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 which devalues the dollar. The president says to the Treasury Secretary, revalue gold. No congressional approval needed. The Treasury Secretary goes to the head of the Fed, revalue gold. Okay, it's 24,000. Now that's $20,000 increase roughly. Every 4,000 is a trillion free and clear.
What's the real value of gold? Well, I can make an
Mm-hmm.
argument based on the true money supply, the way the Austrians look at the money supply, $20,000 gold. So let me back off of that and be conservative. $10,000 gold, maybe
Mm-hmm.
a 50-to-1 ratio, which puts what 50 into 10 is what $200 silver. I mean, are those wild extremes? I don't know. The market does.
In a recent conversation, precious metals experts Andy Schectman and David Morgan laid out one of the most explosive scenarios yet for the future price of gold and silver. The discussion centers on a powerful dynamic in the global financial system. Every time US dollars move internationally, new US treasuries are issued. Because the interest on those treasuries cannot be transferred, central banks and foreign institutions increasingly turn to gold as the only neutral asset available. This steady accumulation pushes gold higher, and potentially much higher. Schectman explains that rising gold prices ultimately weaken the US dollar, creating a situation where the US government could choose to revalue gold without needing congressional approval. In such a scenario, revaluing gold to $24,000 per ounce instantly creates trillions in balance sheet relief. Even using conservative monetary metrics, the implied fair value of gold could reach $10,000 per ounce. With a traditional gold-to-silver ratio of 50:1, that would place silver near the $200 mark. While these figures may sound extreme, the experts stress that markets, not governments, determine reality. And if monetary pressure continues building, the next revaluation of gold could reshape the entire financial landscape. If you found this helpful, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now listen to the interview.
Well, let's just say, for an example, that silver goes to 100. Let's make it 120, so it doubles from where it is now. Well, doubling your money in a year's time is pretty hard to do. I mean, most of your top-notch money managers that have a stellar track record try to compound at 20% a year. It's just a theoretical, paper price of gold. So what you do is you take the base money supply, which is basically all the pieces of paper that are out there, and you have dollars, and then you have ounces of gold that purportedly the Treasury of the United States says, which is 261 million ounces, and you do that division problem, how many dollars per ounce you divide, and you come out with roughly round numbers 20,000. Does that guarantee the price is 20,000 or could be? Doesn't. It's a suggestion of how much paper has been put against a static quantity of gold. In other words, gold hasn't changed whatsoever at all. So why is it 2,500, a few months back, and it could go to 20,000? Or why? Let's just be in real terms. Why was gold worth 2,500, whatever it was a year ago, and it's 4,200 now, up to 4,400 recently? Gold didn't change. That ounce of gold is the same ounce of gold it's ever been. What's changed is how much paper printing has taken place over not only that time frame, but basically over the last 50 years or whatever. And so there's an accounting that takes place of what is the true value of silver and paper, or gold or silver in paper terms. And let me say it maybe more succinctly, Steve. We are in a phase where I said, bottom of the eighth, moving into the ninth inning, as a metaphor, where these two metals take on their ultimate function as money. So if you look back over the 25-year bull market that's been 11 years straight up, a large correction, and now we're in the final innings in my view, it's where there's no limit in a way to what the paper price could be, because up until very recently, both metals acted as commodities. they were trading just above their production cost, which is what you get in soybean oil or cotton or cocoa. Any of the commodities basically are the cost of production and a margin. The margin is usually pretty modest, except in very rare cases where there's a shortage of lumber and it goes into backwardation, that type of thing. Those things are very rare that they even happen, and they usually subside very easily. So in almost all commodities, you can look at what the cost of production is, put a margin on it, and that's the price. Gold and silver do that for a very long time, treated as commodities. But when they start acting as the ultimate money, the money of last resort, the money that I have to have because my currency is failing, that's when they take off. And that's what's happened. So this is confirmation that we're in that point.
It is very true. And where the silver market can trade 583 million ounces in one day, 75% of annual global mine supply is just ridiculous. Yeah. And, for all of these years, it's worked to suppress the price by using paper contracts. But, when you get to a point where the trust has been broken and central banks are repatriating gold and silver, it's a problem. And, I think I've been asked by a few large companies to very, very cool stuff that I want to talk with you about very soon. I can't do it yet because of an NDA, but really soon I want to talk. You've been asked to help with digital tokenized metal by some very large players. And, if someone would have said to me a year or two ago, do you think tokenized gold and silver could upset the marketplace? I'd say no. But now that I think about it, when you talk about central banks repatriating gold and investors now considering and shifting to tokenized gold, you look at the paper system. The global gold and silver market operates on levered fractional system, where a small amount of gold and silver backs a large volume of paper claims. Doesn't work when people stand for delivery. It did work for decades because no one stood for delivery, very few. But now they are. And the central banks are repatriating, and the commercial banks are standing for delivery, and the sovereign wealth funds are. When you talk about tokenized gold and silver, to me, what makes it interesting is that it gives a fully allocated, instantly transferable, and fungible ownership of the real metal. You can post as collateral as well, and this undermines the demand for paper gold. If you do it right, if you know where is it, what form, who stores it, who audits it, and how is it deliverable? If those things are taken care of, you could talk about a sudden collapse in the paper system that's triggered by an unorderly unraveling of unhedged exposures. How far away are we from that? I don't know. But I think that tokenized metal has the potential to be the catalyst for the collapse of this entire paper, gold, and silver scam that's been going on for a long time.
In a powerful new conversation on the state of precious metals, experts David Morgan and Andy Schectman break down why silver and gold may be entering the most critical phase of their multi-decade bull market. Morgan explains that if silver were to reach $120, simply doubling from current levels, the return would be extraordinary compared to traditional money managers who aim for 20% annual gains. But the key insight goes deeper. The true value of precious metals is tied to paper creation, not mining costs. Using base money supply compared to America's official 261 million ounces of gold, Morgan shows how a simple monetary calculation places gold near $20,000 per ounce. He emphasizes this doesn't guarantee the price, but it highlights the immense amount of paper currency created against a static supply of metal. Gold and silver haven't changed. The dollar has. Morgan argues we are now moving into the final innings of the long-term bull market, where gold and silver stop trading like commodities and start behaving as money of last resort. This shift is accelerating as confidence in fiat weakens and central banks repatriate physical metal. Schectman adds that the system built on leveraged paper contracts is nearing stress points. With repatriation, delivery demands, and rising interest in tokenized, fully allocated metal, the long-standing paper markets could face a disorderly unraveling. Tokenized gold and silver, properly audited and deliverable, could become the catalyst that breaks the current system. Let's get into the interview.
Who in their right mind would buy a 10-year treasury when we are printing the currency into worthlessness and we can take it from you, when you can buy gold which has doubled its performance with no counterparty risk? Tough one. Let me think about that and get back to you. So what do? Well, Judy says they're going to peg gold to the Treasury. She said 50-year, which is a little long, but 50, 30, 20, 10, and 5, starting with 50. And she said stable coins will be issued off of those too. But here's the key. They're redeemable in gold. The 50-year will have a very, 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 very small interest rate, maybe 1%. The rest of them will have zero interest rates, zero, redeemable in gold. The more stupid you are with fiscal and monetary policy, the higher the price of gold goes. So it would be a fixed rate. So you get $1 million bond redeemable in gold. What's Tether going to do? Keep buying, keep buying, keep buying, keep buying, keep buying, keep buying, keep buying. Where's gold going? Now we hear all the time about gold being revalued. James Rickards is saying 24,000. He takes M2 and divides it into the gold supply. And there's your 24,000.
Yeah,
now, just as an aside, gold's already at 4,000. Every $4,000 increase from here on gives the Treasury general account $1 trillion free and clear. If he's right, now first I think they'll let it go organically as long as they can. And then maybe they revalue it. Now the revaluing of gold, most of the central banks around the world hold gold in the gold revaluation account. That's the name of it on their balance sheet. Can't make that up. But here's where it's interesting. You let go gold higher, and then you revalue it to some crazy number, and if you let it go organically first, like it's been doing, right? It's doubled in just over a year and a half. You let it go much, 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 much higher, and then you don't have to revalue it as far. But it's an accounting gimmick. Here's how it works. The president says to the Treasury Secretary, revalue gold. No congressional approval needed. The Treasury Secretary goes to the head of the Fed, revalue gold. Okay, it's 24,000. Now, that's $20,000 increase roughly. Every 4,000 is $1 trillion free and clear. That would be $5 trillion that the Treasury general account would get free and clear to pay down its debt or do whatever it wants with. How does it get it? The Treasury issues gold certificates to the Federal Reserve. This piece of paper that says you have claim, not on the gold, but the cash value, the fiat value of said gold. The gold belongs to the American people. So the Fed, counting gimmick, pushes a button, here's $5 trillion. What does that do to the dollar? Collapses it. Right. The dollar devalues. Remember, devalue. Gold goes higher, gold goes higher, gold goes higher. The dollar goes lower, dollar goes lower.
In a striking breakdown of America's monetary trajectory, today's discussion reveals how rapidly the financial system may be approaching a structural turning point. With massive currency creation eroding purchasing power, the idea of holding long-term U.S. Treasuries becomes increasingly irrational compared to gold, which has doubled in value without counterparty risk. The conversation outlines a scenario in which gold becomes the anchor of a new bond structure, potentially backed by stablecoins fully redeemable in physical metal. Under this emerging framework, long-term bonds would offer minimal interest, while shorter terms would carry zero yield. Yet all would be redeemable in gold. The more reckless fiscal and monetary policy becomes, the higher gold must rise to compensate, triggering an upward cycle that weakens the dollar even further. Analysts point out that every $4,000 increase in the gold price provides the U.S. Treasury with an additional $1 trillion in accounting-based liquidity. A presidential order to revalue gold could instantly reset the price to levels like $24,000 per ounce, delivering trillions in balance sheet relief, while simultaneously collapsing the currency's valuation. This potential revaluation, combined with accelerating loss of confidence in fiat money, forms the backdrop for what may be the most consequential monetary shift in decades. If you found this helpful, like, share, and subscribe to The Metal Bar, turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.